Yo, my people, I hope everyone's doing good. Today's video is going to be on selecting important liquidity levels and why it's important to know where these levels are located. We're also going to talk about what 3 things a candlestick can do, and then I got a little brief discussion on the different session kill zones, so the Asian session, London session, New York session, and the London close session. And yeah, let's crack on with the video. Firstly, we're going to talk about the 3 things that a candlestick can do. So the first candle, or the first example, is called an inside candle, and that's when the current candle doesn't take out the previous candle's high, so buy side liquidity, or it doesn't take out the previous candle's low, which is sell side liquidity. So what price is doing, it's just consolidating. Another word for consolidating is accumulating. So price is just accumulating in the range of this candle, so it's just moving sideways on the lower time frames. The next candle is just a directional one, so it's one-sided. And that's when the current candle, it takes out one side of the candle. So on this example, it takes out the buy side of this candle, so it takes out the high of this candle and closes above it. So it shows you that it's going in one direction, and that's to the upside. And on this example here, it's just vice versa. It's closed below this candle's low, or it's closed below sell side, to show you that it wants to move lower to the downside direction. And then the last example is when the current candle takes out both buy side and sell side. And this happens when buy side and sell side gets taken. When you see this in the market, after price is taken out buy side and sell side, price is most likely gonna turn back to to consolidate. So the next candle is likely to just consolidate and inside the range of this candle, because it's already taken buy side and sell side, so there isn't any targets to really target. So price will just accumulate and then figure out what it's going to do next. Now we're going to look at the important liquidity levels in the market. We're going to start off with the previous month's highs and lows. So when it comes to looking for important liquidity levels, unless we're in a consolidation, I'm going to look for price to either reach for one or both sides of the range. So as you can see in the first example on the left hand side, we have our range here from this candle's high to this candle's low, which is the previous month's high and previous month's low. Price then swept the previous month's low and then formed a reversal candle and then moved back into the range. And then to the right hand side, the second example, we have the range again from the previous month's high, previous month's low. This example, however, it didn't form a reversal and it didn't sweep the previous month's low. Price just rallied to the upside and targeted the previous month's high. So as you can see in both of the examples, these important levels are used to form either a draw on liquidity, which was in the second example. So the draw on liquidity was the monthly high, so price was drawing to that area, or it can be used to form a reversal, which was here. So price formed the reversal here, and then it's moving higher to possibly target the draw on liquidity, which would be the previous month's high. On to the next clip of this video. I'm going to show you examples on a monthly time frame of monthly highs and lows being taken out and seeing how price reacts sensitively to these important levels. So each month I've drawn, to separate the months, I've drawn a dashed vertical line to separate each month, and to signify each high and low of the month, I've done a solid black horizontal line, and then carrying on into the next month, I've done a little dashed line to show that this is continuing from the previous month. So as you can see, in the month of January 2024, we have the monthly high and then the monthly lows. The monthly low was taken out in February when price displaced lower. With that displacement to the downside, we got February's high, and then with the retracement to the upside, we got February's low. In March took out February's high, and then it moved back to the downside. It never really reached for February's low, because from here April opened up and then March formed this low. So instead of reaching for February's low, it took out March's low instead. Then it retraced to the upside. So that's the reason why it never reached for February's low, because March's low got formed when April's price action opened, and then it retraced to the upside, and then it displaced lower, and then it took out February's low. So with that displacement to the downside, April's low got formed, and with that displacement, April's high was formed as well. We've got a retracement to the upside. Look how sensitively it reacted to April's highs. Price reached for April's highs, tapped it a bit, and then it moved lower again. And then price moved higher. June opened up. May's high got formed. Then price reacted to May's highs and then displaced to the downside, reaching for May's low, but it never really reached for it. And then price rallied to the upside again to take out June's high. And then again, as it's been doing the previous months, it reacts to June's high, not once, but it does it twice. Then it moves to the downside. Moving on to the next example, you can see that the same concept applies with the weekly highs, the previous week's highs and lows as well. As you can see here on the first example, on the left hand side, here you can see the weekly high and then the weekly low has formed a range. Then price swept the previous week's low and then formed a reversal candle, and then price displaced to the upside using the previous week's high as the draw on liquidity. And then on the flip side, you can see the previous week's high and you got the previous week's low, which has formed a range. However, we didn't get a reversal. Instead, we got the previous week's low just acting as a draw on liquidity, so price just continued to move over to the downside and continued lower. Alright, moving on to the charts now. We have the weekly time frame and we've got a current weekly candle. So what I'm going to do is I'm going to mark out the candle's lows and then the candle's high. So when I'm engaging in the market, what I tend to do is I like to see where the previous candle's closed. If it's closed close to the candle's high, I would expect price to deviate towards that high. So with this candle here, the close was here, so I would want to see price run to take out the high, because it wouldn't make sense to run towards this low. The price is too far away from it, so I would want to see price deviate towards there, which we get. Then with this candle, price is closed in the middle, so it's at the midpoint of the candle's range. So I would sit on my hands for this one and then just see how this candle plays out. So it took out the high, then it took out the low. This candle was already taken out the low, so see how price closed here? It's closed close to the low. Price ran to that low, it swept the low, and then let's see what happens here. So now on the next candle, I'm going to mark out the candle's high and then got the candle's low. Remember when I said here, price closed too far away from this low, it wouldn't make sense for price to run to that low. Got the same thing here. Price is closed closer to here, to the buy side liquidity, than the sell side, so it wouldn't make sense for price to run lower to take out sell side. So I'd want to see price reach for buy side and possibly reach for this buy side, as the market looks like it's in a bullish trend or an uptrend. So price takes out buy side liquidity, then it runs even higher and closes above, or it almost closes above. So with the next candle, again, it's closed at the midpoint of the candle, so I wouldn't really know if price would want to reach for buy side or sell side. So again, I'm going to sit on my hands, as I don't know where it's going to go, and I'm going to see how that plays out. So it reaches for buy side, but I wouldn't have participated in any trading on that week, as I didn't know which way price was going to reach for. So next candle, got the same as I said before. Price is closed, it's closed closer to this high than the low, so I would want price to deviate towards the high before entertaining any sells back into the candle's range. So if we print, we didn't get it on this candle. So this candle, like I said in the first clip, this is an inside day candle or inside bar candle. So price is just accumulated during this week, and then the next week we get the push higher to reach for this candle's high that we were looking for in the previous week. After that, so yeah, price is rejecting off of this candle's buy side liquidity. As you can see, it's respecting it very well. Then we get a close of this candle forming a nice, that's a reversal candlestick, as you can as you all remember from my previous video about candlestick anatomy. If you don't know anything about that, go check that out now. So yeah, we have a reversal candlestick here. Price has closed very close to the low rather than the high. So what I would want to see is price move towards this low rather than this high. So on the flip side of this candle here and this candle's here and this candle here, price is closed closer to the low and further from the high, so it wouldn't make sense for price to try and run for buy side liquidity. It's close, it's in close proximity to this low and even this low as well. Let me do a second line here. And then we have a fair value gap here. So this candle's high to this candle's low. And we've got this gap here that's formed by this displacement candle to the upside. So if I draw a little box here, to show where the gap is. Let me just label that as a weekly fair value gap. So I would want to see price deviate towards these two lows and dig into that weekly fair value gap. And then as you can see here, that's what price has done. So now, look how price is respecting that weekly fair value gap. Like I said before in my previous videos, the wicks do the damage and the body tells the story. So the wick is closed the fair value gap completely. It's completely rebalanced that fair value gap, but the body has closed in it, so it's respected it. It hasn't closed outside of the fair value gap, it's closed in it. So that signals that price could still move higher. However, the previous candle, like I've said, with this candle here and this candle here, it's closed at the midpoint of the whole candle. So I wouldn't really know if price would want to reach for buy side or the sell side of the candle. So what do? We sit on our hands until the next candle's print. And as you can see, the next candle print is giving us more clarity of where the market wants to go. So it's closed pretty close to the high. It's closed close to this high, and it's closed close to this high as well. These two highs have already been taken out. So I would want price to reach for this high next. Let's see what it does. It's left that high open for now, and then it's taken it out. And then it's rejected off it nicely. So that's all that it is really. Just looking at where candles close. If it's closed closer to buy side or sell side liquidity. If it's closed closer to buy side, look for price to deviate towards there and reach for the buy side liquidity, or vice versa. If it's closed close to sell side, you'd look for price to deviate and take out sell side liquidity. And as you would probably expect, the same concepts apply here as well. So we've got the daily, the previous day's high and the previous day's low, which forms this range here. We get a reversal from the previous day's low, and then we get a reversal back into the range that was formed from the previous day's high and the previous day's low. And then on the right hand side, we've got the same thing. We've got the previous day's high, previous day's low, that forms the range. Then we get a move into the range, and then price moves lower to use the previous day's low as the draw on liquidity. So price is drawing towards that low and using it as a target level, and then we get the close below the low. Moving on to the daily examples. I'm only going to do a few. So here we've got this candle. It's closed pretty close to its low. So what you would expect, so we're going to mark out previous day's high and previous day's low. So what you would expect for the new candle is for price to run lower as the close is close to its low. And then on this candle, as you can see, so we mark out that candle's high and that candle's low. So where would you expect price to run first? The low or the high? Would expect the low, because the close closed very close to the low. We did get a very long wick here, which violated this low, and this low. In hindsight, it looks good, but in real time, I would have only really targeted this low and this low, because this close is in close proximity to this low as well. This is a bit optimistic, and this is very optimistic. we probably got a news release on this date. That's why price wicked so low and reached for this low. But moving on to the next candle, we've got the previous day's high, and then we've got the previous day's low. Where would you expect price to deviate towards if the close is very close to this high? You want price to move higher to take out the high, which it did. So price poked above the high a little bit, then it closed lower. This daily candle, price closed at the midpoint of the candle's range. So like I said before, we sit on our hands and see where price wants to move to. So take that. Got the candles high. I've got the candles low, sorry. We've got the candles high. Let's see where it wants to go to. So we've got a full close above this daily high. So now that it's given us clarity on where it wants to go, price is closed pretty close to its high. So where would we expect price to go to? We'd expect price to run this high, which it did. So it poked it. It poked above it a tiny bit. Then it moved lower to close back in the candle's range. Then we got the next candle close. It closed pretty close to its low, and this low as well. Let's see what price wants to do. So the next candle only took out this low. It never really reached for this low at all. So the next candle, price closed relatively close to its high and this high as well. So let's see where this wants to go. So the next candle print, I expect price to move higher to take out this high and possibly this high as well, which it did with a huge spike. And then we got a close back in the midpoint of the range. Now getting to the important part of the video, or the juicy parts of the video. We're going to be talking about sessions liquidity, or session liquidity highs and lows. But before getting into this topic, it's important to understand what times these sessions or these session kill zones form in, or what times that they are in. I said that so crazy, whoops. But yeah, so in the video I'm only going to be focused on the forex kill zones, which are the Asian sessions, the London open session, the New York open session, and then the London close session. There are indices sessions as well, but that's going to be another topic for a whole nother video. So getting into it now, we have 4 different sessions. We've got the Asian session, the London open session, New York open session, and the London close session. So in Asia forms at 8 o'clock, or it forms between 8 o'clock and midnight Eastern Standard Time. That's the most important factor. So it's the Eastern Standard Time. Then we've got the London open from 2 to 5 a.m. Eastern Standard Time. Then we got the New York open, which forms from 7 to 10 a.m. Eastern Standard Time. And then we got the London close, which forms from 10 to 12 o'clock midday Eastern Standard Time. In the next clip I'm going to show you, it's going to be an example on the session highs and lows. So this is the indicator that I'm going to be using on my charts to just label the different sessions and split them up. So it's called ICT Killzones and Pivots by TFO. And just pause the video to fill out the correct numbers and colors for the sessions. Now, moving on to the examples for the session liquidities. We're going to look to trade Friday's daily range, and with where price is at now, if we go on a 4-hour time frame, price is currently trading within this bearish order block. So we've got an up candle with a down move. It's closed, price is closed below this green up candle, which makes it a bearish order block. So you'd want price to move into here like it's done so far, and then move lower. So right now it's moved into the 4-hour order block, and it's currently respecting the midpoint of this order block. Remember what I said before, that the wicks do the damage and the bodies tell the story. So the wick is traded through the midpoint of the order block, but the bodies are respecting it. So if we move over to the lower time frames, now that we can see that we want to move lower, the draw on liquidity that we spoke about in the first couple clips would be previous day's lows. So we've got the previous day's low, which is Wednesday's low, and then we're going to see how Thursday closes out. So if we print until midnight, and then we have Thursday's low printed, and price is closed so at midnight. So we'd want to see price move above an old high before we get the move lower to the downside. So right now the Asian session is printed out, so now we'll wait for the London session where we could possibly get a move to the upside and then move lower to the downside. So if we print again, so price is traded above, so that's Asian sessions highs. Price has moved above Asian sessions highs. Above that session high, we should form a reversal and then move to the downside, which we get a displacement to the downside, and then we would look for our sell positions to then take price and move price to our targeted areas where we have equal lows here, where price will look to deviate towards and punch through, and then we get that move to the downside during the New York session, and then the London close session as well, just to close out the day. And then that's that. You see, Asia has printed out. So now we're going to draw this out in time. We change this to black. So we've got Asia's high, and then we've got Asia's low, print that out there. So, because we're looking for price to target Thursday's lows, and Thursday's lows and Wednesday's lows, what I would want to see is a move to the upside to take out Asia's highs, and we get a bit of order pairing at buy side liquidity. So buy side liquidity sweep paired with short positions, and then we'll take our trades to the downside. So we're printing, that's the London session open, and then we get a move to the downside. I think that's London sessions ended. So we had a sweep of, let me make that red. So we had a sweep of the Asian session. So buy side liquidity was taken, and then we get a displacement to the downside with a little fair value gap there where price traded back into it, and then we could enter sell positions. Let me just do it hypothetically, and then we put our stop loss above the London session high, and then we put our take profit to where we want to target, which is Wednesday's lows. Yeah, we carry on printing. Asian session's low, it's just been taken, as well as the London session low as well. So prices punched through that, and then now we have the New York session open. We could have got another entry in there. Prices retraced back into our entry point, and then prices moving lower to the downside, and then we finally reached our take profit point, which was Wednesday's low and Thursday's low, which also formed equal lows that the markets don't like. And then it tends to punch through that. Who the hell trades support and resistance anyway, man? On the internet, they tell you support and resistance. Like when price bounces off a support area, you take your buys. But the market don't like that. Right? Hands their ass to them, or get their asses handed to them, sorry. So yeah, I feel like that's the correct way to trade, man. Look for these areas there and look to target them.
And now finally coming to the end of the video, I just want to show you just a quick walkthrough of when I'm about to place a trade. So what I tend to do is I look for my draws on liquidity. So this is the week we're trading, the week commencing Monday the 10th of March at 2025. So what I tend to do is I look at the previous week and I see where price is likely to draw to. So as you can see here, so as you can see on this candle, the close, like I said in the previous clips, the close is very close to this low and it's further away from the high. So you would want to target this low for the week, which has already been met, as you can see. So just label that as sell side liquidity. So what you would want to target next is probably down here, which is another close low to the low, which has already been met as well. This low is very optimistic because a weekly candle, a weekly bearish candle wouldn't print that low unless someone like Trump was speaking, or there was a huge like economical event on the economical calendar. So yeah, what we do next is, so let me just, I'll shade these, I'll turn them into dotted lines to show that they've already been met, and I'll get rid of that one. Now we move on to the daily time frame. Now we got to look for daily targets since the weekly targets have been met to go to the downside. So we'll wait for Monday's candle to print. So that's Monday's candle printed. So yeah, Monday's candle printed. Oh yeah, I forgot to draw these lines as well. Hang on. Template. Days of the week. So we got, where's Monday? So Monday midnight, Tuesday midnight, Wednesday midnight, Thursday midnight, and then Friday. I'm only going to show you one day though. So we have the whole of Monday printed here. So our next, because the weekly liquidity has been taken, which is this shaded blue line here, we could look to target Monday's drawn liquidity. So that's what I'd look for now. So I'm still looking for short positions, but I'm just looking for a draw on liquidity, and that's going to be Monday's low as my draw on liquidity. So I'd look for a setup on Tuesday, but price is just chopping around. It's chopping around, and it closes like so. So if I get my tool from here to here, I can see that. So this is Tuesday's high to Tuesday's low. I can see that price is closed very close to the open. So what we do, we sit on our hands until we get a sweep of the high. So if I get a sweep of this high, that's when I know that the market is pairing buy stops with sell positions. So I'd look for a move to the upside before looking for short positions, which we get. So price has taken out buy stops and pairing it with sell positions. So that's buy side liquidity taken into a 4-hour fair value gap. So we got this candle's low to this candle's high. Then we have the displacement to the downside with that candle. And we just label that as a 4-hour fair value gap, as you can see. So price is wicked up and it's closed in the midpoint of that fair value gap, just to signal that, yeah, we're still bearish. So it's respected that midpoint and it's respected the fair value gap as well, and it's displaced lower to the downside. Plus it's during the New York session, so we have Asian session here from 8 to 12 midnight. Then we got the London session forming. Then price moves higher during the New York session.
So price then moves higher during the New York session, takes out the previous day's high, continues to respect this 4-hour fair value gap, so, as you can see, and then displaces lower to the downside for that New York reversal. So we've got the New York reversal, then it moves lower, it retraces back into the range where you could take a sell position. But remember what I said in my previous video when it comes to candlestick patterns.
This candlestick forms in the market, you stay away. It's a huge red flag. You'll never lose money sitting on your hands. So once this candlestick forms, just sit on your hands. Don't chase money. Trust me, you end up on your ass, man.
Tuesday formed the indecision candle. So price opened and it closed. So it opened, it wicked to the downside, another wick, then it closed close to its open. Next day is when we sit on our hands just to get more market clarity. So price opened, moved higher, so it swept Asia's high, swept Asia's high, swept the London high, then it swept the previous day's high, where market order pairing occurs. So price took out buy side liquidity and is pairing it with short positions, so interbank short positions. But we're not entertaining this. A lot of people would still entertain this and try and sell from here, but it could go against them. No, lucky for them. I was going to say a bad word. Lucky for them lot. Price is hovering around. So we move on to the next day now. But going back, as you can see here, so Wednesday or Tuesday formed the indecision candle. Wednesday moved higher, took out previous day's high, and it closed as a reversal candle. So if you look back at the previous video on candlesticks, you got a reversal candlestick now. So Wednesday closed as a reversal candlestick. So now, after you've seen that reversal candlestick, you know price is going to reverse from this area, or it's most likely going to reverse from this area, because in trading we deal with probabilities only. So now you would look to trade lower to the downside to finally reach for your targets. So we have another target here. Got Tuesday's low as well. And we got Wednesday's low to target as well. So we've got 3 different target positions where we could take profits at. So if we carry on printing, so Asia's printed. I don't know why that's printed that twice. So yeah, Asia's low, it's got taken out. Carry on printing, carry on printing. London session's printed now. So we've got London lows to target as well, which has formed equal lows. Look how equal these lows are. We've got this low, and this low. That's engineered liquidity. So the market has done that deliberately. It's missed out that low. It's moved lower. It could have taken it out. It's missed out the low again. So it's just engineered liquidity. So retail traders, as people say, that trade support and resistance, they would look at this area as resistance. And then they would look to enter buy positions. But no, we don't do that. We don't do that over here, B. We move lower. Got the New York session. There was a huge displacement here. So I would want to see price displace through this area here before I look to entertain anything, which we got. Then I would look to enter my sell positions to target. So Wednesday's lows already been taken. London session lows have already been taken. So I would look to target Tuesday's lows and then Monday's lows. So if I enter a quick position here and I put my stop loss above the New York session high, so the New York session is the green shaded area, and then I'll just put my take profit at, let's say Tuesday's lows. Oh, is that Tuesday's low? No, Monday's lows. And then we print it out. Print. Prices move lower. I don't know how to take partials on this. I would have taken partials, but carry on printing lower. Prices reversed heavily. It reversed heavily from Tuesday's lows. So hopefully we could get a move to Monday's. But no, that looks like that's just played out like that. So yeah, you would have just waited. So you wait for Tuesday, so Tuesday's printed as an indecision candle. So you wouldn't want to trade the next day because you're not sure if price would move lower or move higher to take out either buy side or sell side liquidity. So you just wait for extra confirmation. The next day printed higher, took out buy side liquidity where order pairing occurs, and then price displaced lower. Price was still hovering around because of that indecision day, so the market still doesn't know what to do. And then it's closed as a reversal candle moving into Thursday, which has given us extra clarification or extra clarity that price wants to move lower. And then we enter our short positions and then we move lower to reach for our target areas. And yeah, that's that for today's video. If you enjoyed that, please drop a like, comment, subscribe as well, so I can continue to make more videos like this. Because hey man, these videos, they're wearing a brother out, man. So show some love. And yeah man, I'll see you in the next video. Yeah, have a nice day.